This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. As the market continues to rapidly transform, I thought it would be good to have Lawrence Calcano, Chairman and CEO of iCapital, the largest technology platform in the industry, come back on the show to discuss the evolution of the different service models that enable GPs to unlock access to private markets for more LPs. Please enjoy this episode with Lawrence.
We're going mainstream.
Welcome to the Alt Goes Mainstream podcast. I've been having plenty of conversations with people in the industry, GPs, large LPs, and it feels like we've reached a point in private markets where both sides are trying to figure out how to navigate this space, both from a product perspective, technology perspective. So I wanted to ask Lawrence Calcano, Chairman and CEO of iCapital, the largest platform in the space, and seeing all the flows of what's happening between GPs and LPs, to come in and talk about all this. Lawrence, welcome back to the Alt Goes Mainstream podcast.
Thanks, Michael. Great to be here.
Pleasure to have you. And I think this is such an important discussion to have because it really does feel like we're at a point in private markets where there are now technology solutions that can help GPs and LPs connect. There's different types of LPs within the wealth channel who need different solutions. So I want to start with, as you see the space evolving, how are you thinking about the different ways in which GPs and LPs are interacting, and how do we open up this asset class leveraging technology?
Well, thanks, Michael, and it's great to be here on your show. This requires a very holistic solution, right? It requires end-to-end technology. It requires significant education. It requires a lot more transparency broadly. This isn't about solving an issue in the middle of the chain or the end of the chain. It's about solving really the whole chain, if you will. But I think if you ask yourself, what are the key things that need to happen to get to a world where alts are broadly penetrated in all suitable or appropriate portfolios, I would say the biggest impediment right now remains education. People who have embraced the channel have been doing so for a while, but their portfolios still are underpenetrated in alts, and they represent probably 20% of the advisors do 80% of the volume. That other 80% who are very interested in getting involved in this asset class for their clients, there's still a lot of education that needs to happen to bring them into the asset class.
Unpack what you mean by education. What aspects of education is it? The fact they just need to understand what alts are, how alts fit into a client's portfolio, how they actually are able to leverage different products or technologies to help their clients understand and just implement it in a portfolio? What does education actually mean?
It's all of the above, right? In some cases, it's what are these products? How do they work? How do they differ from the public products that I've invested in, during my career? What are the differences, et cetera? So that's a big part of it for a lot of advisors. The second is, how do these products fit into a portfolio? I've got an existing set of client portfolios and they're exposed how they're exposed. How do these products fit into those portfolios? And what should I expect out of those portfolios, once we've made these allocations, both immediately and over time? And obviously, people use the word alts as if it's one thing. The reality is it's a very big asset class. You've got, equity-oriented alternatives, credit-oriented real estate, infrastructure, hedge funds, structured notes, et cetera. And I think in a lot of cases, people think of all of those as being alts. I do think in many respects, they're part of the existing asset classes you already know. Private equity is part of your equity allocation, credit, your fixed income allocation, et cetera. So I think people are still trying to figure out, how should I think about the asset class and how should I put it into my various client portfolios?
Brings up a really interesting point in that private equity is still equity exposure. That
Yes.
does something to a portfolio in terms of liquidity relative to illiquidity, in terms of risk, in terms of return. How should advisors think about all of that, and how do they get the tools that help them think about that holistically? Because it's not just about allocating to this specific fund because you need some private markets exposure. It's how do you allocate to this fund but also get an understanding of what that does to your portfolio?
Well, I think this is the key thing. Like, to me, it's not about one thing. It's not about we're going to lower fees over here and then all of a sudden it's going to get fixed. It's about not how do you lower fees with respect to one specific way in which people invest, but how do you actually lower fees across the whole chain? That's where I think you get real leverage in terms of greater adoption. The elasticity of adoption, if you will, goes up when you change the industry's cost structure. And so I think that's a massive part of what has to happen to get to the next level here.
Changing the industry's cost structure, how do you go about doing that?
Well, it's technology, right? So, you asked about how do I think about building the portfolio? Does it go into my equity portfolio? Does it go into my credit portfolio? Is it a separate asset class, alternatives? I think the reality is you need to have tools that allow you as an advisor to operate the way you're used to operating. And so I don't think many advisors are looking to have to change their entire way in which they function as an advisor to just accommodate this asset class. They'd like to have a similar set of tools and capabilities that allow them to navigate the alternative asset class the same way they navigate the rest of the portfolio. And that's tools to be able to help you build the portfolios, understand the implications of adding alts. It's the ability to learn about and buy these investments in a relatively straightforward fashion, and making sure that your clients are buying the right type of, whether it's a direct investment, a feeder investment, et cetera, and then making sure you have technology to manage the life cycle of whatever you bought for your client, and making sure that it's all integrated into whatever reporting package you're using to report to your clients.
You can obviously help across the value chain with that. What have you seen the GPs who've had success selling into the wealth channel very well? What have they done to effectively educate the wealth channel on this is where this fits into a portfolio, how it fits in, and why it should be there?
Initially, it was about manpower, right? Because these tools did not exist, right? And they still, absent maybe a couple of tools, they still don't really exist en masse. The early GPs who were successful really were in the channel consistently with all their best products, right? So they made a commitment to educating, sort of hand-to-hand advisors, and they didn't cherry pick their products, right? So I think one of the key things, and I remember over this journey, early on, people were sort of unwilling to commit all their products. They were afraid of what are the implications to my institutional investors, et cetera. But the best managers who've achieved success in this space aren't making the distinction between what products go institutional and what products go into this high net worth channel. All of their best products are available to all of their LPs. And that's really important. And the next sort of leg of that is now we're going to build products for the unique needs of this channel, again, based on the best products we have as an asset manager.
So that makes sense conceptually.
Yeah.
But in the supply chain of alts, actually putting products into a client's portfolio may differ based on the client type, ultra high net worth versus mass affluent, how that's done, how they have to think about liquidity. What in your mind has been the biggest investment product innovation?
Well, I think the ability to go beyond the qualified purchaser, the rules and the regulations around who can buy what are pretty clear and important, obviously. And so, historically, the higher net worth clients were buying, feeder vehicles, which we aggregated into one vehicle, and then that fed into one or many underlying managers. But those products are generally not available to accrediteds. And when you think about the number of accredited investors relative to the number of QPs, solving the accredited problem is a bigger problem for both advisors and for GPs. So different structures were needed to account for those investors. And I think most advisors, don't want solutions just for their wealthiest clients. They want solutions for their sub-accrediteds, their accrediteds, their QCs, their QPs, et cetera. And so being able to deliver an end-to-end product set that allows an advisor to satisfy all their different clients' investment needs is really critical.
Bring up a really interesting point, which is the evolution of the industry. When you started building solutions for the industry with iCapital, it was feeder vehicles. And that was also what GPs wanted. GPs wanted feeder vehicles, and they wanted help managing that and managing all the burdens that come with having more investors and rolling that up into a single feeder vehicle. What's interesting about today in alts is that many GPs and large LPs as well, they seem to be saying, hey, we want to go direct. We want to have a direct relationship for the GP with our end client, with the advisors and their end clients. And large LPs are saying the same thing. We want to have a direct relationship with the GP. What does that actually mean?
Like everything else in life, it takes time to get to where people want to be, right? I look at our own flows, 2/3 of our flows over the course of this year, for example, are in direct or accredited oriented products. So, the feeder business represents, a relatively smaller part of our business. Having said that, it's still a big business. And I think part of that mix is a function of what managers are in market and when, right? I think next year there'll be a lot of very large funds that are going to come back to market, which will probably bring up that part of the business. But it is absolutely the case that people want to go direct, and I think that's true for a couple of reasons. I think people look at the ecosystem, the cost structure of the ecosystem, it's still way too high, right? The feeder piece is an important component of that, but it's not the whole thing. It's actually a relatively small piece. The entirety of how the products flow through the ecosystem, from GP to advisor to a custodian, a transfer agent in the case of registered products, administrators, all of those handoffs are actually quite expensive. And there's a number of duplicative activities that just serve to add the cost. And so if you really want to solve that issue, it's not about lowering fees in one area, it's about actually changing the fee structure of the entire ecosystem, which is obviously where we're really focused.
What do you do to operationalize that?
But what you want to do is create effectively a new workflow for the industry with respect to the idiosyncrasies of these types of assets. And leveraging technology, for example, like the distributed ledger, that to me is a game changer in terms of whether it's a feeder product or a direct product. It changes the game in terms of the costs at every stop in that ecosystem. And to us, that's how you really affect the ecosystem. That's how you allow your clients to achieve their goals, whether those are advisors or GPs by creating a more frictionless infrastructure. And by the way, globally, is really critical to be able to help your clients achieve their goals and objectives.
I think there's a really interesting intellectual discussion about fees when it comes to private markets. I think we've been on this evolution in fees. I don't think the world, for the most part, is 2 and 20 anymore if you're a GP. So they're obviously thinking about that. There's obviously this increase in total AUM in private markets that's growing the overall pie. And even if it's not 2 and 20 anymore, there's still a massive amount of assets coming into private markets. So I want to touch on the intellectual aspect of fees in any industry. We've seen it public markets, the vanguardization of fees in public markets. They've cut down fees. They're able to enable more investors to access. Obviously, different firms will have their own strategy when it comes to things like fees, but how do you think about this evolution of fees, fee compression, and cost structure in private markets broadly, and then as you build a business to serve the industry?
You know, iCapital and all of the other constituents have to look very hard about how we automate and how we reduce fees end to end. That's where you actually really drive, increase adoption of the asset class. So we've got to keep doing that collectively as an industry to be able to get to the places people think we can get to.
How much do you as a platform enable GPs to, and even LPs to some extent as well, because of the workflows you're providing, enable everyone else in the value chain to think about having lower fees or not having to charge the end client and investor as much because there's now workflow solutions that maybe there weren't there before? And then any player in the industry, whether it's GPs, LPs, or even technology service providers, they may not need as many people and humans to actually service the industry.
We're in a cycle. I mean, Vanguard, BlackRock, lots of firms over the period of years, if not decades, dramatically use technology to lower pricing, right? We as an industry are still very young relative to, ETFs or some of the other products that are available for advisors. There's a life cycle of how you do this. Right now, I would suggest to you that it's still very much a time for investment. We are not at a point where the industry's mature. You can, stop investing. Whether that investment is in education, as we talked about earlier, or technology, again, which is still early on, there's still big investments required to be able to set up that end-to-end infrastructure to allow the industry broadly to reduce costs in the same way that we've seen in other markets. But having said that, I think people do need to realize that this is still a different asset class. This is not like ETFs, right? So there will inherently be a higher cost in this value chain than in other products. That's really a function of the fact that these are the ultimate, if you will, active assets or investments. And what you're doing as an asset manager to make good investments, it starts with your knowledge of an industry. Obviously, it's critical what you buy and what you pay for it. But as important is what you do with that over the hold period. And so these assets, as very active investments, are going to inherently be more expensive than other assets that might be in the portfolio. The question is the performance justifying of the extra fees? To date, history would suggest that it more than does, right? The returns that people have gotten from this asset class have been significant. And so I think we all collectively have to figure out, where do we drive costs down? How do we drive costs down? But recognize that, there's an important value part of the equation as well, which is always making sure that your clients are getting value for whatever the fees are that they're paying.
You bring up a really interesting point, which is where we all recognize where we can drive the cost down as an industry. Where do you think the industry can and should collaborate in this regard? Because it benefits everybody.
Yes.
GPs, LPs, every service provider in the middle, to come together in some respects on certain aspects of the value chain.
So I think really it's starting with education, right? If advisors and clients really understand their asset class then presumably everybody benefits, all the GPs benefit from the fact that there's just better understanding of the assets. So I would say that education, the industry should be actively and aggressively collaborating on to make sure that advisors understand. That's going to take time. That is not a 2025 project. That's a much longer term project. And then I think the ecosystem, we've spent a lot of time working with the largest advisors, both independent advisors, IBDs, wirehouses, as well as the largest GPs, to try to create an infrastructure that will allow all of them to get leverage in whatever part of the chain that they participate in. So I think the combination of collaboration around education, scale in the industry infrastructure, those two things, collaboration creates, I think, ultimately value for the end client.
Well, the other thing that you mentioned earlier, which I think is relevant to this conversation as well, is helping advisors understand where alts fits into a portfolio and how it does and how it generates excess return relative to the unit of risk that is balancing out that return relative to what else you could invest in. And that again gets to things like providing model portfolios, providing solutions and technology to help them figure that out. You launched IMAP, you launched Architect. How does that all play into this? Because to your point, helping advisors understand this and how it fits in ends up being so important.
It's key. And we're trying to meet advisors where they are, right? And give them the tools to be able to serve their clients really effectively. Because at the end of the day, for everybody in the channel, success has to start with the underlying investor having a great outcome. That is critical. If the underlying investors have great outcomes, then everybody in the chain will find their way to benefit, right? But the model portfolios, to the point earlier of like, how do you give an advisor tools that they are used to working with that is consistent with how they run the rest of their business is essential. So people use models across their 60-40 portfolio. We wanted to provide them a model in alts. And we wanted to effectively get this conversation started by introducing a way in which people could provide sort of full access, or at least, start to fill the alternative part of a portfolio. But as important as the model itself is the technology that supports that model and the workflows that we've built to allow advisors to basically, in one workflow, build that model and subscribe to that model. We fully expect that our models will represent a small piece of the ultimate models that get consumed, but we wanted to give the industry common infrastructure that everybody could use. We wanted to give the industry an infrastructure that if you're a GP, you could build your own model with maybe your own products, but you could build your own model using sophisticated and straightforward workflows to deliver that to clients. Many wealth advisors will want to build their own models for their clients. Again, this technology gives them the ability to build their own models and express their own investment point of view.
I think you're getting at a really interesting point, which also feels to be another emerging theme in the industry. Is on one hand, you're talking about standardization, which is so important. And what if 20% of the advisors are doing 80% of the flows, roughly speaking? And this is at the larger wirehouses even. So there's still so much under penetration in the wealth channel. But there needs to be some level of standardization, but yet don't a lot of investors also want customization?
Yeah, look, I think, the standardization should apply to the infrastructure. Customization, I think, should apply to the types of investments that make sense for each individual investor, if you will, mass customization, right? What you need and what you want, what you're interested in, what you understand, what your risk profile suggests is smart may be different from mine and everyone else, right? So your advisor needs to be able to serve to you the product mix that makes sense for your needs and objectives. Part of what we're trying to do, give people the ability to use technology to create the exposures that are very specifically needed or desired and fit the objectives of individual clients.
How do we as an industry answer the question of liquidity for the advisor and the end client?
It's a massively important issue that is viewed differently, again, by every single investor. Different people have different views of, will they tolerate any illiquidity in their portfolio, to I'll tolerate some, right? And so to me, this is about education. It starts with education. you and I have chatted in the past about like this whole idea of labeling registered products semi-liquid, which I think is very dangerous because people hear what they want to hear. I hear semi-liquid, I might think they're liquid, right? Because we all hear what we want to hear. So I think educating people as to how these products work, I always say that all these products are illiquid, period. Some of them have modest liquidity features, but you should think of them as being illiquid, right? We are spending a lot of time on how to create opportunities to get liquidity in certain circumstances. A big part of this market is their private placements. There is no liquidity, so whatever liquidity is available or is made available will be modest. But I do think that this all fits into when people, I think people overuse the word democratization. There's another word that means different things to almost everybody, right? But the idea of democratization is typically thought of on the way in, right? I want to provide opportunities for advisors and clients to have access to anything an institution would have access to in whatever appropriate structure is needed. But people don't typically think about democratization on the way out, right? If I'm a big institutional investor and I want to restructure my portfolio or sell some names, there's a very active secondary market that I can tap into. That needs to exist for the high net worth marketplace as well.
That brings up a really interesting, broader conceptual point, which is that the remedy to that problem that you just cited is probably a point solution. There's a host of other point solutions that we talked about over the course of this conversation that you referenced. It could be in pre-investment on the diligence side and helping people construct portfolios. It could be fund closing and subdocs. It could be providing a secondary market. How do you think about the evolution of the industry, private markets, across the life cycle of a trade or an investment in this space as having point solutions versus end-to-end solutions, and where do both fit in?
As you know, I spent the big part of my career at Goldman Sachs running tech banking and had a chance going back to the late 80s and 90s and early 2000s watching the all these new companies get formed and grow, and what seems to be true is that platform companies win and point product companies end up struggling to be independent for a long period of time. I think the point products, either become acquisition companies. Some of them, don't make it. But I do think in the context of trying to create this end-to-end solution, it's about a platform, I think, that creates scale, that takes away all the tough interconnection points between constituents and smooths that out and reduces the friction, makes it more efficient and more cost effective. Building a platform is an expensive proposition. We have to think about, as we grow, we have to have a model that makes sense to be able to continue to invest. We have been operating profitable every month since June of 19, and we've continued to invest all that money back in our platform to solve some of the problems we've talked about. We've also seen in our industry, as has been the case in other industries, where there have been a lot of companies over the last 4 or 5 years that have come into the market with either a limited offering or an offering with a very low price that I would say probably half the companies that have come into our space are no longer around because they were not able to build a business model that makes sense. And so to me, these are long-term assets. We have to build a company that's going to support our clients for decades, not for the next 3 months or whatever. We have to make sure that we're providing great value to our clients, which is what we do, what we charge for it, et cetera, and that we're also building a model that is successful, that allows us to scale to support them over a long period of time.
I think that's such an interesting concept that you can probably apply to some of the things that you learn from being in the tech world as a banker and seeing all these different business models. You think about some of the most enduring companies in technology, the Amazon, Salesforces, Googles, et cetera, of the world. They figured out how to build platforms, and they also operated in industries that changed over time, right? You think about something like social media, what marketing did, online or SEO, SEM type marketing did to actually reduce costs in many ways for a number of other companies. Like, how do you think about some of the lessons learned from what you saw in technology and the evolutions that happen in various waves of the internet, first wave, second wave, now we're into the third wave, as Steve Case would say. Like, what do you think are the lessons that you learned from that can now be applied to this industry?
The companies that were thinking about their clients as the core of what they do tended to do well, because they were really focused on solving, A, they understood the issues, B, they had a perspective on where this was all going. And were building capabilities to allow them to serve their clients, not just today, but sort of over a longer period of time. So really having a roadmap to be able to evolve what you're doing and the financial capability to invest in the future before you get a nickel of revenue from it. You've got to be able to kind of anticipate where the world is going. And, as I said, delivering value to your customer over that period of time. I think those companies that have kept the customer at the center of everything they do, how they think, how they create, products, have tended to do well. And because of that focus, they've been able to anticipate where the world is going and make sure that they were there to help their customers get to the next level.
In your mind, where is the world going in private markets?
If you look at the target allocations that a lot of the CIOs have across the independent platforms and the large wirehouses, that would suggest a 20 to 25% allocation to alts. Even if you're shy of that, at 10 to 15%, you're talking about a very significant allocation to this asset class. We think that, for many investors, these assets make a lot of sense. So we expect there to continue to be, more adoption. But as with any market, nothing ever happens as fast as you think it's going to happen. And that's why you've got to have patience. It's why you have to have the sort of financial capability to kind of withstand a slow market evolution. But I think, these assets are going to find their way, increasingly into these portfolios as advisors become more educated and their clients as well.
Going forward, what do you think the biggest technological innovation will be in private markets?
We are, actively focusing on using the ledger to create sort of a more frictionless environment. We're focused on using AI throughout that platform to help people make better decisions. And I think the combination of leveraging data, technology, and AI to help people make great decisions. Education, will be increasingly benefited by the use of AI, the use of data, appropriate use of data to help people understand, where the flows are, how different products perform, et cetera. So I think leveraging all of those capabilities to make this platform I've been describing richer and more value added is an important part of that journey.
Where my mind goes with that comment, that GPs, I think, are the beneficiaries of this, large platforms are the beneficiaries of this, is scale. And scale is actually a winner in a market like this, or any market for that matter. What were you seeing when you were in tech banking that the companies that have grown to the largest size and scale today, what were they doing then that gave them the continued advantage of scale?
So scale matters a lot. I totally agree with you on that point. Scale is what enables you to invest. And, to the question, what those big companies did was they invested consistently into their platform, both organically and then I think thoughtfully added capabilities to the mix to be able to accelerate what they could offer to their clients. And, when I think about it, as it relates to how we've thought about iCapital, we're always focused on building and reinvesting. Reinvest to where we think the market's going, but also to be able to understand that there's a business model underneath that. And I think what you saw with the biggest companies, was that willingness and ability to keep building out more capability in their platform. And customers would realize that what they could do with these platforms was more and more and more, right? And that I think is true. As I've thought about iCapital, we've continued to invest in that platform to be able to serve where the clients are going to go in the future. But I think that's a key thing that the best in breed companies, all consistently did, with respect to their organizations.
Where that takes my mind is there's often things in the short term that companies and people in industries get overly concerned about in the short term, but then in the long term, I think often underestimate things. So what would you say the industry is overestimating today as an issue in the short term?
As an issue, I would say that the industry is probably overestimating how fast it's all going to happen, which means you need to be thoughtful about your investment program, right? If you're a GP, in some cases, you need to think about this channel as being a big permanent channel. I think some GPs, for example, are a little slower to invest because they want to see it come to fruition. I think some of the folks who have been more successful invested because they knew it was going to happen, right? And so you're now seeing, the benefits of those early investments. And I think, from the perspective of other companies in the channel, you're seeing the need to invest ahead of where the world's going. I will tell you from a wealth manager standpoint, having spent a lot of time with the independents and some of the bigger platforms as well, they're really focused on, infrastructure integration. That's a huge opportunity because they're thinking about what does the long-term business model look like? How do we pull together if we're growing organically, if we're growing through acquisition, how do we integrate the platforms we acquire in a thoughtful way across the compliance infrastructure, obviously across the investment infrastructure, the alternatives infrastructure. And I think a lot of them, as they integrate and as they grow, are looking for solutions to help that integration happen, help the data integration, help the technology integration. And I think that, kind of over time, we're going to see that issue, continue to be an important one for wealth managers to solve, to continue to grow.
That's such an important point, is that that wealth and alts, that intersection, that really goes hand in hand, right? In order for the alt space to grow, it needs the wealth space to grow, but it needs to enable that to happen in a way where it fits into, like you said, their workflows. So I think that's a massively important point. I want to flip the last question around and say, instead of what people are overestimating in the short term, what do you think people are underestimating in the long term?
It's funny. I remember when we were back in the internet bubble 1.0, everybody, ourselves included, were doing forecasts of what the internet was going to be. And, and at some point during that sort of 95 through 2000 period, stocks were very expensive, right? And I think people were conflating the valuation of the companies and the size of the internet. And what I mean by that is, when the valuation started to crash, people looked at these internet assumptions, which were still, very significant, and they thought that the internet's not going to happen because they were conflating the valuation with the internet. It turns out that if you look at the wildest projections back then, what's happened with the internet and how people use it and adopted it has been way higher than any of those very rosy projections, right? But so there was a conflation, if you will. But I do think that there will be continued evolution of these assets, into portfolios. There will continue to be more structuring, more thoughtful ways of creating these exposures. I don't think we've really tipped the scales yet on how people will think about creating these allocations. I think there's just a lot of excitement ahead.
I mean, you're in the middle of all the flows that's happening in the industry, given the size and scale of the iCapital platform. Do you think people understand how big this industry can become?
Yes and no. I think, when I talked to some of the big wealth advisors, I was on two separate phone calls yesterday with folks who are building massive wealth managers who see the opportunity to have a more robust investment platform as a core part of why and how they're going to continue to grow, right? So I think they see it, and I think some of the GPs obviously have made pretty significant, not all of them, but pretty significant investments in the ability to reach this channel. There's certainly that that understanding and that enthusiasm and those investments as well.
Yeah, it's fascinating to think. I think we often underestimate how big something can be in the short term because it's hard to see that when you're in
Yes.
it. And sometimes you even can't picture or envision how big something can actually be in the longer term.
Yeah, I just come back to things take time. Like honestly, everything that that I've ever seen throughout the various companies I've spent time with, or the industries I spent time with, is that nothing happens overnight. I was at my youngest daughter just graduated from Dartmouth, and Roger Federer was the commencement speaker, and he did an incredible job. And he effectively said, "I'm going to give you all a tennis lesson." And the first part of the tennis lesson, he talked about how everybody said to him, "Roger, you make it look so effortless," And he used to say that, that used to really bother him. And his sort of first lesson was, effortless is a myth. And his point is, yeah, it looks effortless to you because you're not watching me every single day, morning to night, working and hitting thousands of backhands or forehands or serves and so forth. And so I thought his speech was amazing. And I've, effortless is a myth is a pretty true comment.
You want to make it look easy, even if all the work that goes on behind the scenes isn't, because it should look easy, but we all know it's not.
Nothing worth doing or having that actually creates substantive value is easy.
Brings up a really interesting question for you and iCapital and the industry more broadly, which is, where do you think you need to move fast and where do you think you need to move slow?
It's a great question. We tend to move really fast as it relates to, trying to build technology and trying to, kind of get ahead of where we see needs on a global basis. I think where you need to move slow is around regulatory and compliance. I think the industry is still feeling its way. Obviously, there's been some discussion around, disclosure and so forth. That's very important. By the way, that's not new to the high net worth channel. The disclosure, transparency questions and concerns have been true for as long as institutions have been investing in these assets, right? So I do think that, moving slow and making sure that people understand and are educated and that you're creating the right compliance and regulatory framework is really, really important. The education piece is really critical because a lot of times it can be tempting to want to sell products quickly, but you really need to figure out what the advisor and clients actually know. It's one of the reasons why we're so focused on being B2B, because I think it's almost impossible as a platform, if you're selling directly to consumers, to actually really understand what do those consumers understand about these complicated products. It's why we love working with advisors, because advisors spend their whole lives serving their clients. They know what you really think about liquidity, what you really understand and know about these assets. Are they really right for your goals and objectives? So we like partnering and building tools for advisors because we think that raises the probability that the end client, who I've talked about, has a great and successful investment experience.
This is a long-term game. It's a long-term asset class. So I think that the most interesting difference between tech and finance is that you can move fast, but you can't break things.
Yeah.
So this has been a fantastic conversation. So many aspects of where private markets is and where it's going was covered. So thanks for coming on the Alt Goes Mainstream podcast.
Thanks, Michael. Great to be here.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going